Imagine walking into a bank and handing over $1,000. Then, just moments later, the bank lends someone else $2,000 even though you only gave them $1,000. Sounds like magic, doesn't it? But this almost feels like how modern banking really works. Banks creating money out of thin air. It's a topic full of mystery and, frankly, a bit of confusion. Yet understanding it matters to all of us, because it's at the heart of how our economy functions every day. So, today, let's peel back the curtain. How exactly do banks create money? Is it really thin air, or is there a method to this seeming madness? And what does this mean for your wallet and the economy as a whole? Let's dive in. First, it helps to clarify what we mean by money. When you think of money, maybe you picture the cash in your wallet or the numbers on your bank statement, but here's the twist. What most people regard as money, the physical bills and coins, is only a tiny fraction of the total money in circulation. Most money today exists digitally, as numbers stored in bank accounts. And it turns out that banks have more control over this digital money than you might expect. They don't just hold money, they can actually create it. This process hinges on something called fractional reserve banking. Banks are required to keep a fraction of their deposits as reserves actual cash or deposits with the central bank, but they can lend out the rest. Say you deposit $1,000. The bank might only need to keep 10% $100 as reserves. That means they can lend out the other $900 to someone else. That $900 doesn't come from your existing deposit. It's essentially new money the bank has created. When the borrower spends that $900, it eventually lands in someone else's bank account, and the cycle can repeat. This multiplying effect means banks don't just move money around. They expand the money supply by creating new deposits with each loan. Let's follow the money, step by step. You make a deposit, you put $1,000 in your bank, the bank keeps some. They hold $100 as reserves, as mandated. The rest is lent out. $900 is loaned to someone, the borrower spends the loan, maybe they buy a car, and the seller deposits that $900 back into their bank. The cycle repeats. The bank now keeps 10% of the $900, $90 in loans, out $810 more. What does this look like in total? Through this repeating cycle, your original deposit of $1,000 can potentially generate up to $10,000 in total money supply. Wait. But where's the thin air? It's important to grasp that the new money banks create isn't printed bills, it's digital deposits. When banks lend money, they don't shove physical cash across the table. They simply add numbers to the borrower's account balance. This digital creation can feel like thin air, because it's not backed by a physical asset, but rather by the borrower's promise to repay and the bank's trust in that repayment. The magic is in fact a system of agreements, trust, and regulations that allow this expansion. What about central banks? Central banks, like the Federal Reserve in the US, play a crucial role in this system. They set the reserve requirements, determine interest rates, and control the base money, supply the actual cash and reserves in the system. But they don't create the bulk of money directly. Instead, commercial banks do, by lending. The central bank influences how much banks can or want to lend by setting the cost of money, interest rates, and by managing reserves. So, why does this matter? Understanding how banks create money out of thin air explains a lot about economic cycles. When banks lend generously, the money supply grows, encouraging spending and investment. This can boost the economy, but also risks inflation if too much money chases too few goods. On the flip side, when banks pull back on lending, the money supply shrinks, potentially slowing down the economy, sometimes sharply. And from a personal perspective, it helps you see that banks are not just passive safes for your money. Instead, they are powerful engines affecting how much money is available, who gets it, and under what conditions. But is this creation of money risky? Yes! It can be, because banks lend based on trust that loans will be repaid. Too much reckless lending can lead to problems. Think of the 2008 financial crisis, where risky loans triggered a cascading failure. That's why regulations and oversight exist to keep the system balanced between growth and stability, ensuring the magic doesn't turn into a house of cards. In the end, banks create money not through some secret trick, but through a well-established, regulated system called fractional reserve banking. They transform deposits into new loans, expanding the money supply digitally. It's a web of trust, regulations, and economic forces all working together. Next time you check your bank balance or hear about the economy growing or slowing, remember, there's a lot happening beneath the surface, with banks creating money quietly behind the scenes. It's a powerful tool that fuels our world, but also one that demands respect and understanding. Because money, as it turns out, is less about the bills in your hand and more about the trust and connections between us all.